Good morning, ladies and gentlemen. Good morning. Welcome to the presentation of the Monetary Policy and Financial Stability Statement presentation today. But before we start, I just want to tell you that we have a mobile app that you can download. If you are an Android user, you'll find it in the Google Play Store. And if you have an iPhone, you can find it in the iOS App Store. And this app, you can get all the documents that will be shared today. You can ask questions, and we'll read them through the Q&A session. And also, you'll be able to engage with the panelists. So if you need help, please let us know. We have a team in place that will help you. The team is in the back, so if you want their help, you can let us know, and then they'll help you to download this app. And you can interact. Just a reminder for those that are coming in right now that we have a mobile app. If you go to the Android Play Store, it's called MPFSS app. So you can be able to download and click on join now, as you can see on the screens, and be able to enter in your email and password, sign up your full names, and be able to access documents or ask questions. We'll be able to read them and also interact with the panelists and also follow the agenda of the day. So if you need help, and for the Apple users, it's on the iOS App Store, and you can be able also to download its MPFSS app. We have a team in place. If you need help, you can raise up your hand and we'll be able to help you. once again. For those that just walked in right now, we want to remind you that the video playing in the back is for MPFSS app that you can access on your mobile phones. If you're an Android user, you can download it from the Google Play Store. And if you have an iPhone, you can download it from the iOS app store. You can download it. It's called MPFSS. And you can join and add in your details, and you can be able to follow the event, ask questions, and also you'll be able to access the documents that will be shared on your mobile phone in this event. If you need help, we have a team in the room that would like to help you. You can raise up your hand, so let us know if you need help, and then we can help you to download it. Thank you. Good morning once again. Welcome to the presentation of the Monetary Policy and Financial Stability Statement. Honorable Governor of the National Bank of Rwanda, Honorable Deputy Governor of the National Bank of Rwanda, members of Senate, members of the Parliament present, heads of banks, development partners, distinguished ladies and gentlemen, all protocol observed. Welcome to the presentation of the Monetary Policy and Financial Stability Statement by the Governor of the National Bank of Rwanda. I'm Bob Allen from the Communications Division at the National Bank of Rwanda, and I'm pleased to be your host this morning. As per our agenda, like you have it right in front of you, we'll have the presentation of the Monetary Policy and Financial Stability Statement by the Governor of the National Bank of Rwanda, Honorable John Rwangombwa, followed by a Q&A session with the audience. Distinguished guests, the presentation of the Monetary Policy and Financial Stability Statement consists of key governance imperatives of transparency and accountability of the National Bank of Rwanda. In today's presentation, the Governor will talk about key economic and financial developments, monetary performance, and convey the bank's perspective on the overall economic outlook of the economy. With that said, I'd like to remind you that you'll be able to get documents and presentations that will be shared in this event today, and also on your mobile applications, and also on their website, www.bnr.rw. So, and also would like to let you know that we are live on our YouTube channels. If you have colleagues, friends that would like to follow us, let them know that we are live on our YouTube channel, National Bank of Rwanda, and they can watch live. For those that are on Twitter, social media, Twitter, Facebook, you are also welcome, and you'll be able to follow us also, and also use the hashtag MPFSS 2019 if you want to engage with us and be able to talk to us, send in your comments and your questions for this event. Now, ladies and gentlemen, allow me to welcome the Governor of the National Bank of Rwanda for his presentation this morning. Honorable Governor, you're welcome.
Thank you, Bob. Honorable members of Parliament from both chambers, distinguished invitees to this Monetary Policy and Financial Stability Statement, the first for 2019. colleagues from the National Bank of Rwanda, especially our board members here present with us. It's my pleasure to welcome you to this first presentation of the Monetary Policy and Financial Stability Statement. And I thank you for accepting our invitation, because it's a statement we make to you, the economic actors, and we're happy that you agreed to be with us this morning. So as I was reflecting on the last time we were here, last year, that was August. I think most of you remember one young man that ably coordinated the activities of that day, Samuel Becker. Unfortunately, he's no longer with us, and since we are meeting for the first time since his tragic death, I'd want us to honor his soul by observing a moment of silence. So please, may we stand. May his soul rest in peace. Thank you. So as I said, today we focus on the performance of the economy in 2018, and mainly looking at the areas that concern our business as the central bank, mainly to do with the monetary policy and then the financial stability and the performance of the financial sector in general during the course of 2018. As always, we start by looking at the international context of the global economy, the performance of the global and regional economy that indirectly or in some cases directly affect our performance. As most of you have read from the publications by the IMF, the economy is not doing that well, the global economy, that is compared to where we are 2017. I think from 2015, 16, 17, the economy was picking up. But last year we saw again starting to slow down, and this is expected to continue in 2019. As you see on the screens, 2017 we had achieved 3.8% of the global economic growth. Last year it slowed down to 3.7%, and this is expected to slow down further in 2020. I mean, this year to 3.5%, and this is mainly attributed to the uncertainties in the global economy, the trade wars between China and the US, the uncertainties around Brexit, and as China continues to adjust with its economy, its performance also continues to moderate. So this is really impacting the global economy in general. But when we look at our region, the East African community, we see good performance, and the trend is positive. This is mainly attributed to good weather we had over 2018, expected to continue this year. And so we see the economies of our region, or the average performance of the East African region, improving from 5.2 to 5.9% last year, and this is expected to continue in that positive trend for 2019 to 6.3%. And as I said, it's mainly attributed to that, but we also see increased trade among the East African country that is contributing to this positive performance. When we talk of the global economy, when we want to link that to our national economy, the main channels of the impact of the global economy to our economy, the direct ones are mainly in prices, and especially the commodity prices. On petroleum products or oil, that affects us directly in terms of increasing or decreasing our import bill, and indirectly also can be reflected in our inflation. And on the other commodity prices, non-oil commodity prices, especially the metal, that impacts on our exports, So we track the performance of these commodity prices to see how that will impact on our economy. And as you can see from last year, or in fact from 2017, the energy prices were going up, that is the oil prices, from a big decline in 2015-16. But the good thing to note this year is that we expect this increase to slow down from high of 27.8% achieved in 2018 to 1.4%. So that is positive on our balance of payment in terms of reducing the increase on our export bill. And as you see in the booklets, petroleum products, or oil, is one of the big components that that make up our import bill. So any movements on the prices of these oil products impacts directly our import bill and by pass-through into our imported inflation. At the other prices are the non-energy prices, which is mainly on metals. So we expect to see that also, that increase is slowing down. And we already saw that slow down in 2018. That will be shown in our export numbers. The big growth we had in 2017, we saw moderate growth in 2018. But we expect that to remain positive. At least we don't see any negative growth on our prices, on our commodity prices. So that is really the context in which we look at the global economy. I know it impacts us also on the exchange rates, on the movements within the capital markets across the world, but these are the direct channels that the global economy impacts on our economy. Now coming to our domestic economic performance, I think we can say 2018 was a very positive year. We saw from 2017 the economy was picking up. When you look at we didn't show the entire, yes, from 2015 we saw the economy slowing down, and in fact 2016 we reached almost the bottom of this slowdown, and I think it was 2017 first quarter we grew by 1.7%, and that was the lowest over almost a decade in terms of quarterly economic performance. But we saw the economy picking up again towards the end of 2017, and that continued in 2018. So as the Institute of Statistics has published the numbers for the first 3 quarters, we saw the economy growing by 8.3% in the first quarters of 2018. We haven't seen the final numbers for the last quarter of 2018, so we are not able to give you the actual performance of the economy for 2018. We are waiting for the numbers from the Institute of Statistics. But we at the central bank, we track what we call frequent economic indicators. And these are consolidated in what we call the composite index of economic activities. And when you look at this graph on the right-hand side of the slide, our CIA really moves in the same direction as the actual performance of the economy. So the lower, I don't know, it's black or dark line shows the economic performance over the quarters, and the upper dotted line shows the CIA, the composite of economic activity that we track on a quarterly basis. And when you look at the last quarter of 2018, it remains also positive. As you see, the CIA is growing at 13.1%, and therefore by extension we are showing that the economy is also expected to be growing with good number. So we're not able to state the number today, but when you look at this trend, we are confident that the overall economy performance for 2018 will be much higher, much higher than the original projection of 7.2%. So as I said earlier, when you look at the external sector, when we look at the trade deficit that is putting together both the formal and informal trade with the rest of the world, we see the trade deficit widening by 10.7%, and this was mainly due to a bigger increase in imports by 9.2%. while exports increased by 7.6%, but the base of our exports is much bigger than the imports, and therefore this widened our trade deficit. And mainly, again, as you see, I'm not giving the details here in this presentation, but when you look at the details in the booklet, the good thing to note here is that the big increase in our import bill is mainly on capital goods and intermediate goods that go into our industries. And so while it's a challenge to us, it's big, but at least it's contributing to the expansion of the economy, which is positive. And down below that graph, we are showing the current account deficit that reduced by 9.5% because we had good remittances and other financial flows, and that helps us to cover the trade deficit we are showing above. Again, because of these good movements in the financial flows, we don't see big impact or big pressure on the exchange markets, despite the fact that we had that big increase in the import bill. So our reserves remain healthy, and not only our official reserves, but also the foreign assets, or the net foreign assets, the hard currency held by our financial sector is also positive during last year. And therefore, that was able to moderate the pressures on the exchange rates. And that's why we were able to achieve 4% depreciation against the US dollar last year. So briefly, that's the story around the external trade. But we just wanted to highlight some few items here. We've discussed, I think, about a year ago, we asked what is the impact of Made in Rwanda on our trade balance. So here we highlighted some few commodities that are coming up and are showing good performance in our trade numbers. So we are not able to show how it is reducing on imports, that we can maybe promise to work on that next time, but at least we are able to see textile exports, iron and steel, and mattresses, flowers. In fact, flowers, when you go back, I think you'll see in the booklet, we have the table for about 10 years. You see flowers coming up recently. So this is a good performance. Alan, what's happening? Okay. Yeah, so this is good to note that this is helping us to diversify our exports. Though I said, as we look at the global performance of the economy, we focus on the commodity prices. As we continue to diversify our exports, at least that hit we always get when there are movements on the commodity exports will be mitigated by diversifying our exports to industrial, by including these industrial products that is really performing quite well. Then on the monetary sector, I think we are happy to note that we see improved monetary transmission mechanism. By this I mean when we announce the central bank rate or the monetary policy stance, how that is absorbed or reflects or transmitted through the market operations, we see really good improvement over the last years. And as we told you last year in the Monetary Policy and Financial Stability Statement, we are going to move into a new monetary policy framework, what we call the forward-looking monetary policy framework that will be using interest rates coming from the old monetary policy framework. We're using the supply of money. So now here we are using the cost of money, and we are happy that the market rates are really following the movements of our monetary policy stance. Can I have the slides back, please? I don't know if I'm supposed to be controlling it here or somebody's controlling it. So anyway, but as I can be talking about that graph that was there, when we look at the policy stance, last year we remained accommodative and we maintained our policy stance at 5.5%. We kept on announcing that every quarter after the Monetary Policy Committee meetings. Yes, we're here. So when you look at this graph on the left side of the slides. I hope even here it's on the left. Yes. So that graph shows the red line is our money market interest rate. That is the interbank interest rate, the repo interest rate, and the 28 T-bill interest rate. At least for the last 2 years, we see these interest rates moving in line with our movements on our monetary policy stance, which is really positive. That gives us confidence that we can influence the cost of money using interest rates, and that, at the end of the day, will influence the performance of the monetary sector in general. What is also good to note, for the first time we see the lending rates and deposit rates also going down, following this trend that we've had. We reduced the policy rate from 2016. I think we had 7, we came down 6.5, then 6, then 5.5. And now when you look at the numbers from 2017, the lending rates that many people are really interested in, because it's what impacts on the lending and borrowing from the private sector. For the first time, we see the lending rates, average lending rate going below 17%. As you know, we've always hovered around 17.5, 17.3. So at least we see average lending interest rate for 2018 at 16.96. And the good thing to note is that for the first 2 months of this year, that is at least from 1.5 months, we see that also going below the 16.96. And that was before BPR announced their reduction in their base rate. So this is positive in terms of how the monetary policy is linking to the market. And it's not only on the lending rates and deposit rates. Down we are showing the money market, I mean the capital market rates. We also see all the government bonds on the capital market also going down in terms of the interest rates. So this is really positive, and it's also explained by the stability we see in the economy, which is normally gives confidence to financial actors to reduce on their interest rates. So this is one of the positive stories we see, and we expect to see that trend maybe continuing. Again, at the end of the day, reducing of the interest rates and all that, if we don't see movements on the credit to the private sector, it wouldn't have any impact on the economy. And when we went accommodative starting 2017, it's because we saw slow growth in credit to the private sector. So we wanted to impact with sending signal to the financial sector to increase lending to the private sector that will impact on the economic growth in general. And we are happy to see that there has been a positive trend in terms of the increase in credit to the private sector. The graph on this side shows how deposits, the increase in deposits. Of course, banks use deposits to lend to borrowers. So we see good increase in deposits from 2017 was at 12.4%. Last year it increased by 15.9%. And we see that reflected in the increase in the new authorized loans, increasing by 17.2% compared to 4.6% we had achieved in 2017. So this is linked to increase, again in your booklets, I don't know if I have it on this slide. No, in your booklets you see a table showing the movements in demand for loans. So at least we saw increase in demand for loans. And because, again, as we see, the non-performing loans were reducing, though it's also partly linked to write-offs. I'll come to that in the financial sector side. But we see also banks increasing their approval rates. In terms of the rejection rates, reduced last year compared to where we were in 2017, because we see improvement in the credit risk as well. So this is a good story showing that the financial sector is really increasing their financing of the private sector and the economic performance in general. This graph this is our main mandate. Our main mandate is to control inflation, to ensure price stability. And we're happy that 2018, this was really very, very moderate. In fact, was below our lower band target of 2%. This was mainly attributed to good performance in agriculture, which also impacts on the performance of the economy in general. And so we expect this to slightly increase to around 3% for 2019. So we expect to see inflation remain below our medium-term target of 5%. And this is linked to many factors: the monetary policy stance we are taking and the good performance of the real sector that dampens the increase in especially food prices. So that brings me to the end of the first part of my presentation on the monetary policy side or the economic performance in general. So as I move to the financial sector performance side, I just wanted to bring this slide that links the two parts of our business. So one is financial stability and the other one is price stability. So how does economic performance link to financial sector performance? So they really contribute to each other. So when one is healthy, the other one is automatically healthy. When one has challenges, it impacts the other. So I don't have to go through all these bullets, but you see how a good economic performance will increase mobilization of savings and will really allow financial institutions to have resources to allocate to productive investments. And these will increase economic performance in general. And as the economy performs well again, it's able to allow the investors to help the business, and they're able to service their loans. So they really contribute to each other, and it's good that we are able to monitor the two. And if you follow our quarterly meetings, normally the Monetary Policy Committee and the Financial Stability Committee are held back to back, and we link these two to complement each other. So as I said, on the financial sector side, happy to note that we continue to see growth, overall growth in the assets of our financial sector. It's increasing by 14.5% last year compared to 13.7%. And this is linked to the increased deposits and increased lending, especially from the banks, as we saw. Because we'll see slight decline in the assets of the insurance sector because there was no big increase in their capital that has been driving the increase of their assets. So overall, again, the slide or the graph on the right-hand side of that table shows you the structure of our financial sector. Banks remain dominant as the subsector of the overall financial sector, followed by the pension sector. But as you see, the good thing to note on the 2018, we see the private pension funds coming into play for the first time, and they're already taking up 0.8% of the financial sector in general. And so we expect to see this growing and really widening the pension sector that also supports investment, mobilization of savings and investment, and support the population to be assured of good retirement packages. In the banking sector in general, we see, as I said, healthy growth in their assets by 15.1%. And this is, I had already said, there was capital injection. I think we had two banks mobilizing big capital, so that contributed to their assets, though it increased their liabilities, but they're able to have assets in form of cash that they use to lend. Again, we see on the right-hand side, that's the composition of the assets of the banks. As you can see, loans and overdrafts, loans to the private sector mainly, takes the lion's share of the assets of the financial institutions, which is good, shows that they are doing their intermediation mandate and supporting the performance of the economy in general. In fact, when you see there was increase in the private sector credit and reduction in government securities for the course of 2018. And there's health performance, this impacts on the performance of the banking sector in general. One thing to note here, I'd slightly touched on it, was though we see good performance in the non-performing loans, the rate reducing from 7.6% to 6.4%, we still have a challenge of non-performing loans. And therefore, as you see, there's red numbers we put up there in those on the second bullet. We see write-offs increasing from 47.9 billion to 49.7 billion. So for the economic actors that are here, not the banks, but the other borrowers, this is very negative to the financial sector, and it keeps the cost of lending high. So if we are able to reduce this cost of non-performing loans and write-offs, that should impact positively on the performance of the banks, on the cost of the loans the banks extend to their borrowers. We see increase in provisions in general on the red bars we see on the right side, but this is linked mainly to IFRS that was introduced last year. This is a new accounting standard, but this doesn't hit directly the profit and loss accounts of the banks, but of course it impacts on, increases their provisions. Again, positive to note is the increased performance of the banks in terms of profitability. When you go in detail bank by bank, we don't give that information to the public, but the good thing here is really most of the banks, some of the banks that had made losses last year, they're able to make marginal profits, and therefore when you put together the aggregated profit for the banking industry, you see almost doubling their profitability. So we see good recoveries, again, as you see on that table, 26 billion last year compared to 14.2% that was achieved the year before. The forex gains, this is mainly revaluation gains. So though there were also big sales, as you saw, we had a big import bill, so there was some gains in the big sales. But this 17.8% also has revaluation gains that contributes to this good performance in the profitability of the bank. So at least it's good to see that we generally profitable as a financial or as a banking industry. And that is also linked to the stability numbers we follow. All our banks are healthy in terms of their capital base. We measure this by the capital adequacy ratio, and our minimum requirement is 15%, but on average they're at 25.5% last year. And as I said, there are banks that mobilized big capital during the course of last year, so this increases the average from 21.4 to 25%. And also on the liquidity side, as you see, we changed the measure of the liquidity of the banks, but it's also very healthy, from 100% minimum to today they are standing at 637% of their liquidity ratio that we monitor as a central bank. So they are liquid, they are strong in terms of capital, and the profitability has been good. The dark side has been on the write-offs, and we expect, as we'll see in the outlook, we expect to work with the banks to improve on their underwriting business and to reduce on the NPLs, and also we are working with other institutions to improve on the recovery of the securities of the banks. On the microfinance sector, it's also positive. As I said, linking the two presentations or parts of my presentation, when the economy is doing well, the financial sector is doing well. So we see the microfinance sector also doing well, both in terms of their profitability and in terms of here we saw growth in assets, growth in their deposits, and that is also linked to the quality of their loans improving. Here last year we had high NPLs in the microfinance institutions, but we see this improving and the loans growing as well. So there's also health performance across the sectors or subsectors of the microfinance institutions. And financial stability indicators we follow, again, we see strong capitalization of the microfinance institutions in general. There might be some few that are struggling, but in general, as the sector, there's very good capitalization, very good liquidity. In fact, we see maybe high liquidity, the microfinance institutions sitting on 100% liquidity ratio above the 30% that they're required to maintain. And we see good return on their equity and assets as well. So there's healthy performance in the microfinance institutions. And the challenges, again, I'll come back to that in conclusion, the challenges we see in Umurenge Sacco that were discussed during the Umushyikirano here, we are working with the different stakeholders to address that. On the insurance sector, we see good performance, the assets growing by 13.7%. As I said, there was slight slowdown in the growth of the assets of the insurance sector in general because one, RSSB increased the payments they are paying to medical practitioners, and so that reduced slightly, increased the expenses, of course, reducing on the assets. And we didn't see big injections of capital in the private insurers as we have seen, but at least the growth from the private sector insurance industry is more or less the same as we had in 2017. So good performance in terms of the asset growth of the sector. Then here we look at the profitability and the performance of the insurance sector in general, because this was problematic years ago, especially on the private sector, on the private insurers. So I will focus on the right part of the private insurers. We see at least from 2017, they started turning around their loss-making business, and we are able to mainly reduce on the underwriting losses that was impacting on the business of the private insurers. So last year, we see this loss still there, but reducing from 6.9 to 4.2, and that impacting positive on the upper line of the profit in general. And so the big profitability of the insurance sector is coming from investment, not from their main core business of underwriting risks. And this is a concern that we are working with them. But the good thing, as you see the trend, the red line from 13.4 to 6.9 to 4.2, at least there's a positive trend, and we expect this positive performance to continue. Here we look at the stability numbers, again, focusing on the private insurers. For the last 2 years, at least, we've seen the solvency ratio for the industry being above a minimum requirement of 100%. So last year we ended at 165%. We still have a concern on the claims ratio that is still above. No, in fact, claims ratio is slightly below our minimum requirement, but the expense ratio is still way above the 30%. So we still see a lot of sort of inefficiencies and challenges within the private insurance sector that we continue working with them, and we hope we'll be able to reduce on these challenges of high expenses linked to this business. We just highlighted the motor insurance because it has been a problematic area. This has been the biggest driver of bad performance in private insurers. It has been really the worst performing product in the private insurers. And last year, with the increase of their premium rates, this has eased that pressure. Though they're still making losses, but at least we see the underwriting loss on motor insurance reducing from negative 4.3 or reducing from 4.3 billion to 1.5 billion. And as we continue to work with them to remove other inefficiencies within this business, we expect to see this working, improving further. So we commissioned a study towards the end of last year to look at how this business is performing. And we expect this study to be finalized, and in fact, we're discussing it tomorrow with the different stakeholders. And this will inform whether, I remember last year here, somebody was asking on the increase of the prices, and as they increased it at the beginning of last year, it was understood that the increase was 60% at that time, and this year they were to add the 40% and make the overall 100% increase that was supposed to be done based on the 2014 study that was done by an actuarial firm. But it was necessary to do another actuarial study before we allowed any further increase. And so that is finalized. We'll be discussing it tomorrow. Maybe by March, you should know what is happening in terms of the performance of this business. And there are many actors, not just the policy rates. I think there are many other actions that has to be taken to strengthen this product. Yeah, on the payment systems, we also oversee the payment systems, not just as regulators, but we are key actors in promoting the improvement in the payment systems in our country and moving to the target government has given itself to move Rwanda into a cashless economy. So we see new products coming on the market, which is really good. We see lending and savings, micro-lending and savings coming on the market, which has, you see the numbers, I don't have to go through the details of the numbers. This started, I think, in 2016, and this has been picking up. It started with MTN with CBA, but we've seen other financial institutions coming up, introducing digital products that are really, when you look in the booklets, when you look at the numbers of borrowers last year, 2018, it greatly increased because we had many, many small borrowers using these digital platforms, which is really positive to drive financial inclusion and support our citizens in the lower pyramid and lower part of our pyramid to access financial services. So these numbers shows how they're able to borrow, how they're able to save, and there's a lot of infrastructure improvements going on from the financial sector point of view, but also as a central bank, we're improving our RIPS. We are upgrading this. It should be working 24/7 and should be able to bring on board non-banks and provide more services that also improve on the e-payments. Again, here we looked at the points of sale. When you look at the traditional points of sale, the ones using cards, I think the performance, I didn't put the numbers here, but you have it in your booklets. The performance increased from, I think, 60-something billion to 89 billion. That is from 2017 to last year. But what is interesting to note here is that the mobile POS introduced by MTN last year, it started just last year. Within 1 year, it had transactions of up to 21.8 billion paid over this platform. So this gives us confidence that with these new technologies that are cheap and easily accessible everywhere in the country, this drive to cashless is, we're going to see good performance. The graph here on the right-hand side, we track this, the e-money value of e-money transactions to GDP. This has been growing every year, really in healthy performance. But with these new products, the virtual POSs, there's the Chia by EcoBank, there's these mobile POSs, and we working as an industry to put in place an interoperability platform or switch. And when this is done and we're able to link all these scattered solutions, we expect to see bigger performance in terms of moving digital. So we encourage all the actors here to really work together with us to drive this cashless performance. So as I conclude, briefly on the outlook, I kept on referring to this anyway. So we expect to see continued good performance of the economy this year. The projection we have from the Minister of Finance from last year was that the economy this year was expected to grow at 7.8%. But we expected this to be revised depending on the base of the performance of last year. So maybe before the end of March, we will expect to see a new number. It might remain the same or it might change. So we just brought this as a projection we had from the numbers we had from last year. And as I said, we expect to see inflation stable, averaging around 3% if things remain as projected, especially on agriculture. If we don't have any shocks in agriculture, we expect this to remain moderate. Again, when you look at the best we have in terms of the foreign exchange resources within the financial sector, the expected performance of our external trade and external our financial flows, we expect the exchange rate pressures remain subdued. I think the projection we had was around 4.5, but that will also be confirmed after March, after we've looked at the total economic numbers. So with all this, we expect to remain accommodative. How far, whether we increase our policy rate, whether we reduce our policy rate or maintain it where it is, that will be determined by the Monetary Policy Committee that sits every quarter. But the conditions are conducive, and so we expect to remain accommodative and continue supporting the financial sector to support the private sector borrowing. On the financial sector side, the general statement is that we expect to see the financial sector remain stable and sound. The conditions we see, as I said, on the economic side and the measures that have been taken within the financial sector in general, so we expect this to remain stable and sound. Again, as said earlier, we'll continue working with the banks to enforce proper writing and classification. As I said, this is our concern that we continue working with the banking industry to address. We are working with the different actors to address the issues in Umurenje Circle. On the insurance sector side, we are introducing risk-based capital requirements. We've started testing that with the industry, and we expect this to strengthen the performance of the sector in general. And we continue working with the different actors to improve our payment systems towards a cashless economy. We did the education campaign in 2017, and we expect to do another big one this year, this time more targeted to the economic actors. And as always, I know the MDs of the banks and other financial institutions who don't want to see this last slide where we continue improving our regulatory framework. I think they always question how many regulations are we issuing, but I think it's in the interest of stabilizing our financial sector and putting it on international standards that gives us room to continue supporting the performance of the economy, but also growing the financial sector in general. So I don't know if briefly or in detail, that's the summary of what you have in your booklets, but I really encourage you to read the details in that booklet that gives you the status of the economy in 2018 and our outlook for 2019. So thank you for your kind attention.
Thank you, Governor, for your presentation. Just to remind you that you can have all these documents. You can access them. I saw some people taking a picture of the presentation, but you can access them on our website, www.bnr.rw, and also on our MPFSS app. If you may download it, you'll go to the documents section and you'll be able to access the governor's presentation and also be able to access other documents. We are now moving to our next session, which is the Q&A session. If you have any questions on the presentation or anything in the booklets, we'll be able to answer those. But before we go in that session, I'd like to let you know that joining the governor is the Deputy Governor of the National Bank of Rwanda, the Chief Economist, of the National Bank of Rwanda, as well as the Executive Director of Financial Stability at the National Bank of Rwanda. But before that, I would like to share just a few takeaways from the Governor's presentation. The financial sector is expected to remain stable and sound. The microeconomic outlook of East Africa economies continues to strengthen, and the inflation is expected to remain low, and also pressures on exchange rate are subdued. Muri uyu mwanya turagira ngo twakire ibibazo bitandukanye mushobora kuba mufite wenda kuri ikiganiro Guverineri wa Banki Nkuru y'u Rwanda amaze gutanga, yaba ari ibibazo mwabonye mu dutabo mufite imbere yanyu. Uyu waba ari umwanya mwiza wo kugira ngo tubaze ibibazo. Hari abantu dufite bafite za mikoro bari budufashe kugira ngo ibyo bibazo mubibaze kandi babashe kugira ngo babisubize. But before we go in that direction, I have a question, Honorable Governor. In December 2018, you announced the adoption of the price-based monetary policy framework that we are moving in as the National Bank. What are the expected benefits of this new framework?
Yeah, thank you. Let me request our Chief Economist to handle that question. Thank you.
Yeah, thank you, Governor. I think it was very clear from the presentation. One, by using interest rate as operating variable or objective, we are able today to influence the movement in money market interest rate. This means treasury bills rate, repo rate, interbank rate. This is very, very important. It helps banks, for example, to manage well the liquidity, but also we can now have some influence on market rate, means the deposit rate and the lending rate. And as you know, lending rate is very important. It's part of the cost of fund to business people. But as shown also in the presentation, we are now able to influence the debt security interest rate, means treasury bond, which is very important as a cost of borrowing by the government, but also as a cost of borrowing by the private sector when we will have corporate bond market working properly. So this is very, very important in terms of benefit to our economy. But also, as the governor said, the new framework has what I can call the forward-looking aspect, which is very, very important also, because when you talk about a return for your investment or for your savings, you are not interested by what is happening today, but you are more interested by what will happen tomorrow, because this is where your investment will start to give you return. So by influencing interest rate, the central bank today can give good information about the trend in interest rate for the future, 1 year, 2 years, or 6 months, which is very, very important information for the economic actors. Thank you, Governor.
Thank you, Chief Economist. Like I shared, we have people in the room that have microphones, and I would like to open the discussion to the audience. If you have questions, you can raise up your hand, and people will, our team will be able to give you a microphone. You can see there's the first question. You may say your name and who you're addressing the question to.
Good morning, everyone. My name is Ike Roniga Carol, and I'm a student from IRCA. And from the presentation of the governor, he say that the inflation rate is expected to be stable, but we have seen that the lending rate has decreased. The export revenue are also increasing due to the Made in Rwanda policy, and also there is the introduction of easy access to financial facility, or I can say the mobile money and other e-money. How are we going to stabilize the inflation rate when there have been injection of too much money in the economy? Thank you.
Thank you. We have a question on the front row.
Yeah, thank you. I'm Shumbusho from Cobank Rwanda. First, let me start by thanking the Honorable Governor for his lucid presentation. I've got two brief questions. One, Honorable Governor, in your presentation, you mentioned some things which are happening in our international economy, such as the trade war between the US and China, Brexit, negotiations, and so on. I'm sure this might increase actually the volatility of the financial system, and that might have an impact on us. What kind of measures do we have in place to be able to cushion that kind of impact? The second one is about in your tracking of our economy, how long does it normally take for a macroeconomic indicator such as inflation to be impacted by the policy rate, the central bank rate? Thank you.
Thank you. If there are two more questions, and then the governor will answer those. But if you're still thinking about them, I'll let the governor answer those two questions. Or there's someone, okay. Yes.
Thank you, Governor. I have 2 or 3 questions. The first one is not a question as such, is just a comment.
Can you introduce yourself, please?
My name is Gaudens Kanamugire. I'm the CEO of MUA Insurance Rwanda, formerly Phoenix. My first comment is I'm from insurance sector, and I've seen a great improvement in the presentation of insurance outlook. This is very commendable, and I would like particularly to thank you for this. My second question is I've seen in your presentation about the capital adequacy, be it from bank or banking sector or insurance. Recently, we have got a regulation increasing the minimum capital for banks and insurance. And in the presentation, we saw that the statement says there is adequate capital. I would like to ask you, particularly the underlying message between the statement of adequacy of capital currently and the increase of minimum paid up capital. Again, looking at the return on asset and equity, which is fairly not that much big, 1 billion to 3 billion for insurance. I would like to know the underlying message for particularly investors, because this doesn't show like an incentive for investors. Another question related to this is within the tax law, there is a provision of taxation of retained earnings. I know we have discussed about this in other forums, where any bank or a financial institution which would like to recapitalize the retaining earnings, this will be taxed by 15%, and this I would like to again request like an advocacy. I know we might have RDB here and RRA. If something can be done about it. Thank you.
Thank you. Let's try to make our questions short and straight to the point. If we have one more question, we can take one more question and then we'll get answers.
So I think we can be answering those?
Yes.
Yeah, thank you. Again, as I said, we are here as a team, so I've done the big part of making the presentation. My colleagues should be doing the big part of answering the questions. But let me start with what Gaudence said on taxing conversion of retained earnings into capital. As you said, I think that we'll continue to discuss it with you, the Minister of Finance, and the other government officials or institutions responsible for that. So there's no straightforward answer to that, but I agree with you, work with the different institutions and the government agencies responsible for that. So I request and the good performance on the insurance sector, I think, one, we commend the investors that have been really pumping capital into this sector, and that has maintained the performance or the health performance of the sector, but also the players, and specifically Kanamujira as chair of your association. I think we appreciate the collaboration we've had with the Association of Insurance Companies in Rwanda over the last years. That has reduced the negative practices that were in the industry, and that is positive. So we expect to continue working together to address the few remaining challenges there. So I request Peace to answer the question on adequate capital versus the capital adequacy ratio we've shown that was good versus the new requirement on increased capital, minimum paid up capital for almost all the financial institutions. Then my colleague Monique will handle the question on inflation and the big injection of money from the student of ERCA. And the chief economist can help with the question from Shumbush on how long does it take for it's like our transmission mechanism, how does our policy rate impact on the inflation, and then measures to deal with the global trends. So, Monique.
Thanks, John. My sister from ELCA. This is a good question. And precisely for the very reasons you've mentioned, including now the financial sector growing more and more sophisticated, new channels, new ways of financing the economy, even beyond banks. That's precisely the very reason this new framework we have entered in, which is price-based monetary policy, is very instrumental. It allows us actually to signal so that we can anchor the expectations of all economic agents through the prices, because the prices are more visible than what we used to really use to monitor, which is aggregates, which you only can flow from banks, yet there are other flows happening outside the banking system. So we are able to still perform our monetary policy decisions efficiently, because we have now a new framework that is allowing us to follow those trends and to track them and to anchor the expectations going forward using the signs of interest. Like what they have shown in the presentation, the alignment of the stance and all the money and market rates around it, that is signaling to whoever has to take a decision to save their money, save where, is it in term deposits, is it on capital market, or borrow money to invest, borrow from where. I mean, it's more transparent for everyone to take decisions that are aligned to the stance, which is aligned with the level of inflation that we want the economy to settle around the same. So I think we are still capable and more empowered to do so. But this really requires to continue building our analytical capabilities and also communicating with the markets and different economic agents so that they can interpret what we are seeing happening and what we want the economy to be steered towards. And with that, we can still achieve stable inflation.
Thank you.
Thank you.
Yeah, thank you, Governor. Let me probably add just one comment on the question raised by the student. Probably this will help her to perform in her exam of economics. As the Deputy Governor said, that's a very interesting question. In the presentation of Governor, it was clear that the inflation will continue to be low and stable. But on the other side, we are ready to continue pumping more money in the economy. So the question is to say, how are you linking the two objectives? Just what Deputy Governor said, you need to understand how money is linked to prices. That is through the aggregate demand, means consumption by the private sector, investment. So we at Central Bank have different models helping us to estimate what we call output gap, means to see where we are in terms of economic performance compared to potential level of economy. So when the output gap is not big, you have room to inject money in the economy without creating pressures on the prices. This is just a comment. Now the question about how we link the development in global economy with performance of our economy, I think in the presentation of Governor, it was also clear we follow some variables. We follow some sectors like export, import, because we know that the trade balance has implication on the movement in exchange rate. Exchange rate, which is linked to inflation, to the, either domestic or imported inflation. So we have a system of tools helping us to put together factors or information from the global economy which may help us to take measures on our own economy, and they also link with some projection we have on domestic growth or domestic credit, and we advise the Monetary Policy Committee to take decision to really continue ensuring that the macroeconomic stability in the country is there. The last aspect of the question is how long the decision about monetary policy stance impacts, how long it takes to have the monetary policy stance to impact the inflation. That's a very good question. I think you have the economic review with you. We have a paper that is on page 29. For those who are familiar with econometrics, you can see how they propose the methodology incorporate already this kind of lag of transmission. But to not complicate life here, we take into consideration the possibility of lag, and we use our own data to test how much it will take to have impact on inflation when the MPC is sitting today. Different papers done by our team in Central Bank show that the lag will be between 6 and 9 months on average. It can be 1 year or 8 months, but on average, the lags are between 6 and 9 months. Thank you.
Thank you. Please.
Thank you, Governor. Maybe just to complement on what Chief Economist said regarding the question from Mr. Shumbusho on volatility of global markets and how the financial sector locally is cushioned. From the financial stability side, we view that as a measure of capital adequacy ratio. So within the capital adequacy ratio of 15%, we do actually have a 2.5 buffer that is supposed to help, for example, specifically to banks, to protect them against any shocks. And if you followed the presentation by the governor, we actually have, when you're looking at capital adequacy ratios of 25 vis-a-vis the minimum requirement of 15%, that gives us the confidence that the sector would be able to withstand any shocks arising from any global trends or shocks to the global financial system. Moving on to the question specifically asked by Gaudence, one, I'll start by clarifying that the minimum capital was not from 5 to 50 from banks. It was actually from 5 to 20 for commercial banks, and then 50 is actually the minimum capital requirement for development banks, just to clarify that. And then the question really is comparing two different, but I know they're related, but they're really two different issues. So the capital adequacy ratio is really measuring whatever capital the bank or the institution is holding, in your case an insurance company, whatever capital it is that you're holding, is it sufficient vis-a-vis the risks that you're taking on? So the capital could be $1 billion, it could be 10, it could be whatever it is that your minimum capital is. But vis-a-vis the risk that you're taking, do you have sufficient capital to withstand any shocks? The minimum capital, on the other hand, really is a basis of how much risk can you take on. For example, on the banking sector, if it is lending, the lending is limited to the size of your capital. Same thing for insurance companies. And to also clarify that, as an example, for example, our minimum capital for banks was $5 billion. But today, none of the banks actually have a minimum capital of $5 billion. Everybody has above $5 billion. I think the least being 8, but going up to, I think, 20 plus billion francs. So the rationale really behind the increase of capital was to enable our local institutions take on more risk locally. We have been seeing cases of financing of the economy being also taken from outside of the country, and we want to be able to take a lot more of that onshore. So really that was the rationale of increasing the minimum capital. On the question about the returns on equity, returns on asset vis-a-vis the requirement to increase capital, that is a good and valid question. And I think for those that are involved in the financial sector here, you will have realized that a lot of the conversations that we've been having one-on-one with the banks, for example, is how do we improve efficiency? If we become more efficient, then we'll be able to improve on the returns on equity, which will be a convincing tool for the institutions that seek to raise additional capital from external markets. So agreed that there is still some work to be done there, and I think we continue to look on the players in the financial sector to become more efficient, to improve the returns so that we are able to attract more capital into the financial sector. I think that would be it.
Thank you so much. With your permission, Governor, I would like to take 2-3 questions.
Continue, still have time, I think.
Okay, we'll take another round of questions. Mushobora no kubaza no mu Kinyarwanda, and you can say your name and who you're addressing the question to.
Thank you. My name is Deogratias Dushimo Mukiza. I would like to ask a follow-up question on what the chief economist explained. He said very well that because of the existing output gap, pumping more money into the economy will not put pressures on prices, but rather will contribute in reducing the output gap. Then should we then expect that because of the reduced output gap, we expect to see the unemployment pressures significantly going down? I know maybe I'm crossing the line to the fiscal policy, that I'm just curious to know the impact of pumping more money if it's not on the pricing side, whether the unemployment pressures are expected to significantly go down. Thank you.
Thank you, Deo.
Thank you, Honorable Governor. My name is Navi Sibirinita from Access to Finance Rwanda. And my question is about the non-performing loans ratio. You did mention that though this had improved, this was an area of concern. So I was wondering what were the causes of, not that unexpected, lack of that expected performance that was envisaged, and what is going to be the focus of the central bank moving forward to address that?
Thank you. More questions? Yes, we have questions on this side. If we can have a microphone.
Thank you. My name is Christian Dushime. I'm a student in economics in ULK. As we were explaining about the framework that you are using, I have understood the framework which is called price-based framework. So I would like to ask you if there are some instrument that you will use which is different to the instrument that you were using when you were dealing with the money-based instrument. Thank you.
Thank you, Dushime. Do we have any more questions? Okay. As we're waiting for more questions, we can answer those.
Yeah, thank you. I think the questions on monetary policy will still go to the chief economist. On this question on why we had increase in NPLs, can I request our colleagues from the banking industry to contribute to answering to this question?
Can we have the microphones?
I know the chairman of RBA is not here. We have the two vice chairpersons, or any other MD can handle the question, but I think it's good we hear from the industry. And let's start with that.
Please, if we could have the microphones in front, on the front row.
Okay, you're still consulting chief economist. Please, let's handle outside. Yeah.
Yeah. Thank you, Governor. Let me start by the last question about price-based, the monetary policy, and the new instruments. We don't have a new instruments. since 1997 in Rwanda, we have adopted the market-based monetary policy instruments, but some of them were not used under the monetary targeting regime because we didn't have a well-functioning money market. But today, we are seeing different instruments, what we call open market operations, standing facilities, interbank rate working. So the instruments were there, but they are now working better today than in the previous framework. The first question about the link between output gap, money growth, output of money increase in economic activities will have pressures on the structure of the jobs. We have to say that we don't have numbers and
it's growing, and we've seen within the banking sector, but also sectorial performance. So we've seen some sectors within the economy that have been under more pressure than others, and those we obviously take into account now on our credit assessments going forward. And we can see it specifically. We saw it in agriculture, and we should see better returns this year because we've had better performance from a climate point of view. We saw in the hotel and entertainment or hotel industry as well. There was large investments, but maybe poorly structured loans with shorter payback period.